Well, welcome everyone to this month's webinar. It's great to see everybody. Hope everybody's doing well. So I am Bruce Rosenblatt. I am the owner and the founder of Senior Housing Solutions. And if you don't know, I am a senior housing expert. I have been doing this for over 30 years. And so I help people become educated about the different senior living options in this area. So I'm pretty much the foremost expert on senior housing, and I enjoy helping people become educated about, what choices they have. And I offer a very valuable service because it does get a little confusing out there. I also try to be a resource for people in this area. And through those, as being a resource, I try to connect people who are more knowledgeable than I am on different topics. And so today we have our guest speaker is Eric Marvin from H&H Wealth Management, and he's going to talk to us about the market and how to be healthy during during these financial times. So Eric, I'm going to let you take it, and then I'll share your screen, and we'll go from there. So welcome, Eric.
Thanks, Bruce. Appreciate the introduction. My name is Eric Marvin, everybody. I am a certified financial planner. I've got about 15 years of financial experience. Take it to the next slide there, Bruce. There we go. So I'm originally from Cleveland, Ohio, so I was one of the smart ones that decided to get out of Cleveland, Ohio, especially wintertime. University of Akron, I had a BA in finance, about 30 miles south of Cleveland. I started my career in the insurance industry working for MetLife. Then I gravitated over to the brokerage side, worked for Merrill Lynch for about 7 or 8 years. Then I got to the point where I just said, you know what, no more proprietary products. I didn't want to necessarily be responsible for a certain amount of mortgages that I had to hit. So decided to become an independent advisor. And then that got to the point where I decided I wanted to have my own firm. So I've had my own firm, M&M Wealth Management, for about 8 years now. Been a certified financial planner. I'm also a chartered retirement planning counselor. So I do have vast experience on the financial planning side. So today I kind of just I'm going to kind of breeze through a lot of this. A lot of stuff is probably pretty basic and mundane for a lot of people, but if you pick up a nugget or a tidbit here, it's probably worth it. I'm a stock guy overall. So what I do for folks is I usually charge a flat fee to manage assets. I don't have any proprietary products. I don't sell anything. I don't make any commissions. I am 100% fee only. So, go through some of these topics, like cryptocurrency has really been big in the news lately. Coinbase just had their IPO yesterday. Kind of want to touch on some of that stuff. Just kind of get into the ETFs and the funds and bonds and, what's going on in real estate right now with all of these crazy, bidding wars that you're probably seeing locally. So just kind of want to go through a number of different topics, touch briefly on the long-term care, life insurance, annuities, to just kind of get into, some of these things and kind of do a deeper dive. So, real quick on stocks, you've got value stocks, we've got growth stocks. So for as long as I can remember, growth stocks have always, at least in the last 5 to 10 years, given you more, bang for your buck, so to speak, over value. We've kind of seen that shift a little bit in the last 6 to 12 months, where value is kind of coming back to the forefront. So, your old boring traditional names like a Gilead Sciences, for example, which pays almost a 5% yield, but it's kind of been stuck in its own tracks. Some of those names are starting to come back into favor here, versus the high flying Teslas of the world, which they don't really pay any kind of dividend yield. So, this year's been fairly kind to value. You've seen that sector rotation, that shift a little bit from growth to value. So when you've kind of seen some of the, going back to COVID, you've seen a lot of these online platforms like Robinhood, a lot of these online forums like Reddit. There's been just a vast movement, and it's been a lot from the millennials, and the younger investors of the world that have, wanted to get more involved, and they've just seen they've had an easy market, I will say, because the market from doing this for a long time is anything but easy. So, I had friends telling me last year, well, if you weren't up 100% last year, you had a lousy year. So, but we all know that that's far from the truth. So continue with stocks. You got large caps, small caps, so again, large caps, 10 billion or more. You typically have a lower beta or a lower risk on large caps over small caps. So traditional names, Disney, FedEx, Boeing. I remember buying Disney at $80 a share in March of last year, crossed 200 a couple of weeks ago. FedEx at $90 a share. So there were some incredible valuations on some of these just traditional household names last year. Small caps have run extraordinarily off the bottom. You've had a 98% run in the Russell 2000 compared to a 59% move on the S&P just in the last 12 months. So a pretty big move off the bottom there. So dividends. So we just talked briefly about growth versus value, right? So most of my clients are cash flow people. So they love to get those dividend checks. They either take them as a check form or we reinvest the dividends and buy more shares. So generally speaking, you're going to get better downside protection when you have these, cash cows, so to speak, that offer these dividends. Just a little bit of an extra buffer usually versus a tech stock, for example, that may not pay a dividend. So some of the stuff I do on a day-to-day basis, I get into what we call technical and fundamental analysis. Lots of different, factors that I look for, different moving averages, different things called relative strength. Are the stocks being accumulated by institutions or are they being sold by institutions? I don't know if any of you saw, if you own Viacom or Discovery Networks or any of these, a couple of Chinese names in the last couple of weeks, there was a fund that literally blew up. So these positions went from, being up 100% on the year to being down in a matter of days. So lots and lots of things that are going on in the market. So I use the technical and the fundamental to try to see, just give me another buy signal, another factor, and kind of my, arrow in my quiver, in my arrow to kind of, make a decision here. So I like technical and I like fundamental. Fundamental has kind of gotten away from us because everything has been running so aggressively lately. Real quickly on bonds, bonds for folks that don't know, just a basic 101, they're debt instruments issued by governments or corporations when they need to raise money for a certain project. So basically they're going to give you a cash flow or a coupon, so to speak, as your, way of getting paid back on your initial loan to this company. So you've got all kinds of different, maturities with bonds. Right now, the interest rates have moved fairly aggressively. I'd say from about 14 months ago where we hit our lows, mortgage rates 30 years are now back over 3%. We were getting 2.5 on a 30-year fixed mortgage less than 12 months ago. So, when interest rates typically move, the bottom portion here on this chart, bonds are sensitive to interest rate movements. So they typically have an inverse correlation. So when you get that rise in rates, you typically get that little bit of a sensitivity to your bond principal. So if you look at the 10-year treasury, which is kind of what you may hear a lot in the news, it was 0.53% in August of last year. Now it's 1.67%. So you see that big move in the 10-year treasury just since August of last year. And because of that, mortgage rates, everything that kind of trails that have all gone up as well. Mutual funds, a lot of you may have mutual funds in your own portfolios. The mutual funds are nice because they give you a basket of goodies. So you can go out and pick, American Funds Growth Fund, for example, and you get 200 different, income and growth type investments in there. So you allow your pool, you're pooling your money basically with other investors. But what you do with mutual funds is you don't necessarily call, your broker, for example, at 10 in the morning and say, hey, I want to buy XYZ mutual fund at XYZ price, because they can't calculate the price of your mutual fund until the end of the day by doing what they call NAV or net asset value. So on days like, if you remember back to 2008, or we had these big swoons in the market, you can't sell your mutual fund until they calculate the price at the end of the day, which is the net asset value. So a little tough sometimes because you do lose a little bit of that liquidity premium, versus an ETF, which I'll show you here in the next couple of slides. Mutual funds charge what they call expense ratios. It's what I call a soft dollar expense, meaning you are not physically writing a check to pay for the cost of your mutual fund. They're taking it out of the money that's invested. There's also different share classes there at the bottom, A, B, and C share classes. So when someone presents to you a different share class, A shares charge what they call a front-end sales charge. Basically, when you buy into it, they're taking it off of the money that you invest. B shares are what they call backloaded, and they also have something that they call a 12B1 fee. It's kind of like a declining surrender schedule is the best way to describe it. So it may start at 6%, go to 5, 4, 3, 2, 1 as the years go on. And then C shares are basically what they call level loads, usually a flat 1%. So you don't have anything necessarily coming off of your initial investment when you go into it, but they usually, take a static 1% of the, and those have kind of all, A, B, and C share classes have kind of given way because there's what we call no load or no fee mutual funds as well, which the Vanguards of the world, Fidelity has a lot of them, Charles Schwab. So the fee class is kind of being phased out. That's more what it was 5 to 10 years ago. So ETFs. So basically very similar to mutual funds, but the reason I like ETFs is what for liquidity purposes. So you can, they move up and down all throughout the day, just like a stock will. You do not have to wait until the end of the day to get the net asset value pricing here. They're much less expensive to own from an expense ratio standpoint. So whatever trading platform you have, if it's $7 trades, you're going to pay $7 trades for the ETF as you would a stock. They give you the ability to do a lot more niche, a lot more diversification. I mean, they have water ETFs. They have ETFs that now can track Bitcoin, for example. So you have a plethora of investment choices, more so than you do in mutual funds. Another one is called REITs, so real estate investment trusts. So for example, this crazy real estate market that we're in right now, especially locally, where it's very hard to, if you're a real estate investor, very hard to find a good deal without potentially getting yourself in a bidding war and paying more than you may want to pay. Real estate investment trusts give you that liquidity to buy into the same marketplace as you would an individual stock, but they give you cash flow. And the nice thing about the real estate investment trust is you're liquid. So you want to buy something on a Monday and sell it on a Friday, you can do that. Obviously, with real estate, you don't have that liquidity until you actually sell it. So liquidity versus traditional real estate. Real estate investment trusts off of the March 2020 COVID bottom, we'll call it. They've done pretty good. And you've got to remember too, with REITs, they tend to do okay in a rising interest rate environment. And they're, versus bonds, for example, which may have the opposite effect, and your principal on your bonds may get hurt a little bit, depending on how far you out, what kind of bonds they are. But the nice thing about the REITs is they do give you that little bit of a nice buffer during a rising rate environment. Cryptocurrency. So a lot of you may be familiar with it. We've seen Bitcoin just cross over 60,000 this week alone. What is cryptocurrency? Basically, it's a digital decentralized currency. You can use it to buy goods and services. Tesla, for example, will allow you to take your Bitcoin and buy a Tesla right now. And they use something called a blockchain, which is basically a database that records, verifies ownership, handles how we control the creation of additional coins. But it's been around since 2009. Most people don't realize, but you could have bought Bitcoin for under $1 for probably a couple of years, and now we're 60,000 plus for one Bitcoin. So it's astronomical to think how quickly it's gone up. And now with the IPO yesterday of Coinbase, which is now the largest platform that you can use to trade Bitcoin, it's just going to, provide that much more easier access to the masses. Commodities, gold, silver, copper, platinum. I always say, the stuff that hurts when you drop it on your foot. So traditionally, we think of commodities as,
Oh, we lost you, Eric.
against, if we're worried about a falling U.S. dollar. Got gold 700. So the metals have kind of been stuck in the mud over the last couple of weeks to months. But I think, and I'll show you my last couple of slides, there are a lot of
Oh, I think we lost him for a second.
Yeah, I'm trying to come back here.
Okay, there you are.
Now? Okay, sorry about that. So yeah, I mean, I think silver, I like gold here. I think you're going to start to see these as we get into the end of the year. I think you're going to start to see these make a move. And you can do these via ETFs as well, where you're very liquid. So you don't necessarily have to buy the physical commodity and store it somewhere. If you want to buy it through an ETF, you can. You've got liquidity. You've got full trade. 2 days you're liquid. After you sell it in your account, you can move the money back to your checking, for example. You can use pawn shops like Cash for Gold places, different jewelry stores, but the exchange rate is not that great, when you're trying to cash in some of the physical, gold and silver right now. So all good stuff to keep in mind. Real estate. So again, we touched on this briefly a little bit ago. We're 14 months ago, we were historic. We're still historic, but we were super, super low in terms of on the 30-year, I was getting 2.5, mortgage broker in town was getting 2.5% for some of my clients on 30-year mortgages. There's just no inventory at all right now. So, the other thing that I think the reason why I think you'll still see this market continue to be a seller's market for the foreseeable future is this mortgage foreclosure moratorium that Biden just signed back into effect through June 30th this year. You've got, a little bit, if that expires, you've got some more inventory that will come online. But as long as that's here, and as long as rates aren't going anywhere for the foreseeable future, which they're not, this could continue for another year, year and a half, 2 years potentially. They just have to get more inventory online. I've done a lot of real estate investing in the past, and there's just no deals to be found right now. Very, very tough if you're an investor. Life insurance, briefly, all kinds of different forms of life insurance. So I started my career, and I've got an insurance background. So term, universal, what we call VUL or variable universal life, or whole life. So term, just like it says, you buy a term policy, it's for a finite time period. A lot of people and a lot of older term policies have what they call conversion features. So if you do have one of these potentially and you are not insurable anymore, you can look for these. They're expensive to execute, but you can convert a term policy to a permanent policy. So something to look for specifically in your language if you're getting near your term and you still want that coverage, but you may not be insurable. Universal life is permanent coverage. It's generally less expensive than whole life. You do have a little bit of flexibility with your premiums. They can be more adjusted on a case-by-case basis. They do build cash value. So again, it's cost of insurance, what your rate is. Are you, standard? Were you rated by the insurance company? Did you get preferred rating? So all of that kind of goes into effect. The VUL, very similar to a universal, but you build cash by using investment sub-accounts versus having just the guaranteed rates of the insurance company that you would have, similar on a universal policy. Whole life tends to be the most expensive form of insurance. It builds cash value the same way ULs and VULs do, but it is viewed as, because you do get more guarantees there, it is viewed as generally the most expensive permanent side. You can be very flexible, do a lot of interesting stuff from a case design standpoint with whole life policies. So I have used them quite a bit in the past, but you just have to know what you're, what we're trying to accomplish with them. So non-guaranteed versus guaranteed, like some of these UL policies back in the 1980s, they when rates were, 13, 14, 15%, they were basically underfunded. So the insurance companies would sell folks on, these great universal policies, but then as the years passed and the rates dropped, now you've got to start putting a lot more money into these things to keep them going. So again, if you've got a UL policy that may be underfunded, something you may want to look at. But most of the time, when I quote insurance policies, I only look at guaranteed, because the non-guaranteed, it is what it is. It's a crapshoot. So we want to talk in guarantees, especially when we're talking about life insurance, which is guaranteeing a tax, free payout to our beneficiaries at some point. Long-term care. The long-term care policies have evolved so much just in the last 5 years. Traditionally, they have about 6 or 7 what they call activities of daily living right now. So things like bathing, eating, dressing. Typically in a traditional long-term care policy, you're going to get about $160 for nursing home coverage and home health care. They usually have a 90-day exclusion period. Some are 30, I've seen 60s, but 90s pretty much the norm. 3 years is about your max coverage on these long-term care policies. Most of the statistics will say that people do not use these policies generally for past 12 months. 12 to 18 months is usually your sweet spot of where these things fall. Not a lot of people go past the 2-year, 2.5-year, even 3-year mark. $3,400 right now is the average cost for a 60-year-old couple. I get the question almost weekly of what's the magic age to buy these long-term care policies? Is it 50? Is it 60? I would, err on the side of saying you probably want to purchase it later than earlier, because you may be paying for a bunch of years, and the premium difference between 50 and 60, assuming not a lot of stuff has changed health wise, is not that drastic as people think. So you avoid paying for some of that LTC, but hopefully in that 50 to 60 year age range you won't necessarily need to use. So we're using a little bit of an arbitrage there. Some of these new longer term care policies, you may have heard the term money guard. I saw the Mutual of Omaha guy on with us. Lincoln Financial has a product called Money Guard, where they're basically using permanent insurance, and they're using long-term care riders on some of these permanent insurance. And you can do, what's neat about these products is you can do what's called 1035 exchange from an insurance policy, even from an annuity, into these new Money Guard type products. And they have return of premium riders. So if you don't need it, they say, hey, you can get your premium back. So there is a lot more flexibility with these things. The downside to these types of plans is they tend to be considerable amount more expensive than traditional long-term care policies. So, but that's kind of the new wave that you see right now with where long-term care is heading. Annuities, all kinds of different types, variable, fixed, index annuities. I see 3 to 4 to 5 different annuity account statements every week, and typically the question they're asking me is, how do I get out? They typically have 7-year surrender schedules on variable contracts. You've got different sub-accounts, just like a variable universal life policy in the previous slide. Usually average cost is 3 to 4% a year on top of the mortality and expense ratios. When you add up all the different sub-account fees that are, for the different investments, any rider fees that you may have. So I always ask, folks, are the guarantees worth it? And for some people, they are. I've got several folks with annuities. I'm not necessarily a big proponent in annuities, but they do make sense in certain situations. Fixed annuities, you've got a lot lower, earning potential, but they do guarantee your interest rates. They lock, very similar to how a CD structure would work. Index annuities, you track like an index like the S&P 500. However, they typically have longer lockup periods, longer surrender periods. They do lock you in at what they call high water marks every year. So the market goes up in the first couple of years where you get in the contract, go from 100,000 to 110. Your baseline now is 110, and you can never in theory go below that 110. But there's lots of moving parts in these contracts. There's a lot to kind of under the surface, so to speak. A couple of strategies. So, you've probably heard the old tried and true method of, when you're ready to draw down your portfolio, you should take a 4% withdrawal rate. It's always kind of been the norm out there. Well, a lot of people have had a lot of good years in the last couple of years coming out of 2008. The market's been in a historic uptrend. So you may have had very nice growth in your portfolio where you say, hey, 4%, I could do 5 or 6 or 7% withdrawal rate and still not touch principal. So, you always want to look with your advisor, your financial planner. What I do is I revisit that financial plan for a client every single year. What was our compounded interest from the year before? How much do we take out? What's changed in your life budget wise? Do you need more discretionary income? So on and so forth. So we do what's called Monte Carlo cash flow analyses, and we can do what's called what if scenarios. So what if I want to take 2 more vacations this year? What if I have to spend additional money on healthcare? So anything that we can have scenario wise, we can run in the financial planning software that I have to say, okay, show me what it looks like if we don't have a very good year in the market. What if we lose money next year in the market? How is that going to affect our income or our principal that we're taking out cash flow wise? Quick little outlook here, and then we'll wrap it up. Just do a quick Q&A. Like I said, markets continue to digest tame inflation data. Rise in interest rates lately has not seemed to put much of a damper. The market's been focusing on the positive vaccine outlooks. We had J&J halt a couple of days ago. I don't think from a stock perspective, it's that big of a deal. Infrastructure rollout here, you're going to see under Biden. I continue to be a big believer that this is going to be another good year to be invested in the stock market. I also think that, you look at Bitcoin, we talked about it going past 60,000, IPO Coinbase. I'm a believer here, at least short term, that it's probably what I call a sell the news event, selling the news of Coinbase's IPO. Could it go to 100,000 plus Bitcoin? Sure, it's very possible. Is it going to do it this year? I don't know. I think it probably goes to 30 or 40 before it goes to 100. I do like things like silver and gold as we head into the end of the year and inflation starts to tick up into next year. I think energy infrastructure plays, certain areas in tech. I do like value still. Value has not had its moment in the sun in a long, long time. So getting these, mega cap 4, 5, 6% dividend payers where their price appreciation has been stagnant, for the last little bit, I think is a very, very good place to park money. Q&A basically. So I'm a big believer in education. So like I said before, I don't sell any kind of products, nothing proprietary. I'm a certified financial planner, so I always have to act as a fiduciary. One of the reasons why I wanted to get my own firm is because I never wanted somebody tapping me on the shoulder saying, hey, you got to hit your quota for this month, or you got to do this month in mortgages. So we don't have any of that. Everything is, education first. And, I always tell people the investments is actually the easy part. The hard part is getting to, the planning process. So open up for any questions that people may have.
Eric, that's great. I just have a question for you, and I'm sure other people might have other questions, but can you kind of simplify what the Bitcoin and, because to me, it's a very confusing concept. Can you just simplify that?
Yeah, I mean, it's a digital asset first and foremost. Okay, so you have a platform like Coinbase, for example, which is going to be your custodian or your broker. So if you wanted to go on and buy Bitcoin today, the simplest thing to do would be to open a Coinbase account. Okay, and you could buy Bitcoin, you could buy Ethereum, you could buy all the Dogecoin, all the other cryptocurrencies which are out there. And so basically it's a digital asset on what they call the blockchain, which is a fancy way of saying a computerized database that tracks the transactions, right? That tracks how many new coins are allowed into the system. So in theory, like Tesla, for example, I mentioned, they now accept Bitcoin as a payment for a Tesla if you want. And other Fortune 500 companies like PayPal, you can pay other people, vendors, providers in Bitcoin instead of US dollars. So it's getting to the point where it's never going to necessarily be on the same level as the US dollar, but it's going to be close as we head into the future.
Interesting. You know, I see the people who are part of this call, and many of them are older people. And so I was curious, like, what advice you would have for people as they get older with their investments. Should they, you know, invest more conservatively? Should they,
Sure.
you know, so what advice would you have for people?
Yeah, I mean, like I said, most of my clients have worked X number of years in their, in their fields, and they've accumulated a nest egg, right? A pot. So they don't necessarily need to get rich. They need to stay rich, so to speak, for lack of a better word. So my first and foremost, before we even think about how do we make money, is how do we protect money? So the foot always has to be on the brake before we can put the foot on the gas pedal. So yes, I love things that pay us dividends or pay us cash flows, because that gives us another safety measure, especially during a downturn or a downdraft in the market. So when we have a bunch of things in our portfolio that may be growth oriented, we're going to have a great year like last year. But if the market flips and we do have a correction, that may seem like we may never, but if we do have a correction, you generally get more safety in things that pay you cash flows, bigger, well-capitalized companies. It's just an additional safety net. So yeah, my folks are more income folks than they are growth, folks. But it's good to have a little bit still growth in there, regardless of our, of our risk tolerance levels.
Great. So I'm going to open this up for questions. I'll unmute everyone. Anybody have any questions for Eric? I know my group is pretty, they don't ask a lot of questions, Eric, so they may email you. So how can someone email you and
That's okay.
get input of you?
Yeah. So the last slide there has my number. I don't know if it has my email on it, but I will make sure that I get that over to you, Bruce, and we can.
So, yeah, I recorded this, so I'll be sending a link out to everyone. So I'll include your email on that.
I had a question about the cryptocurrency.
Yes, ma'am.
I mean, on the regular currency, you have a physical element, but you don't have any with the crypto. So
right.
Yeah.
It's difficult because it is a digital currency, right? So
right.
it is also, and here's the downside to cryptocurrency. It has been a way for money launderers, people to, get access to different things, because there's not, you can remain anonymous when you make a Bitcoin transaction or any cryptocurrency transaction. So you do not need to put your name, social security number, any identifying factor for yourself like you may in a traditional US dollar transaction, right? If you go to your bank, they're going to want to make sure it's you, verify your identity, do all of that. But digital currency is a whole other animal, where it's literally tracked on multiple computers. So it's very, very hard to determine who is even making what transaction. So that is something that they're going to have to, if they want to bring it more into the mainstream for the masses, they're going to have to potentially get it to the point where it's more easily identifiable, because there is a dark side to the cryptocurrencies, and people that use it because they know they don't necessarily have to be identified.
Well, wouldn't that result in wild swings in the price?
It does. Yeah, and that's the other thing with Bitcoin, is it's 24/7. So the stock market is off on the weekends, right? Bitcoin is never closed. So the market is always moving up and down. So that's the other thing too, where it makes it a little bit more of, so for my folks that have conservative risk tolerances in profiles, I tend to stay away from it just as an investment, because it tends to have, it could be down $5,000 today or $10,000. There's just very, very wild price swings. So I do have some folks that do have exposure from an investment standpoint, but it is a very small fraction of, overall of what we do.
So what would you recommend, like 1 or 2% of a portfolio?
Yeah, it's less than 5%. Yeah, I think 5% allocation is probably the most I have in terms of. But the nice thing about Bitcoin too is you can use an exchange traded fund that gives you access to invest in Bitcoin. So you don't necessarily have to you could, if you had a Charles Schwab account or a Fidelity account or wherever your brokerage account was at, you can buy it through them. So you don't have to necessarily go out on your own and switch providers to buy it, on its own, so to speak. And that's what's going to help bring it more to the masses, is you can invest in Bitcoin across many different investment vehicles. So there's a Bitcoin ETF right now. It's called the Grayscale Investment Trust, and it has a stock ticker symbol just like a regular stock would, and you can buy and sell that just like a stock.
Eric, there's a lot of talk about corporate tax rates going up. Do you think
Yep.
that that's going to impact negatively on our market?
You could have given me a list of things that I thought would impact us negatively over the last 12 to 18 months. But here's the thing to always remember about the markets, is they are always forward thinking. Okay. Markets generally tend to think at least 3 to 6 months into the future today. So what we may be talking about on CNBC or Fox News or any of the media outlets, the investment community, at least in terms of the stock market, has already priced it in. So even before the election was won, the market was already pricing in a Biden victory. So because they were already pricing it in, they were already potentially pricing in some of these corporate tax things that may be coming to the fruition down the pipe. So we're looking at infrastructure, we're looking at continued positive success of the vaccine rollouts here. The market was a little concerned about the J&J news the other day, but no, from a corporate tax standpoint, there has to be, that other proverbial shoe to drop, and I don't believe that will push the markets in any meaningful way. I mean, you could look at, car loan delinquencies potentially could be coming up the pipe. A lot of these, 1.5%, 2% interest rates on car loans we've seen over the last 5 years or so. Mortgage rates, we don't have the problem with the arms on the mortgage rates like we did back in 2008. So, and I don't even see housing in a bubble right now. As silly as that sounds, I think maybe a year or two from now, we may be having a different conversation, but until more inventory comes online with housing, and rates aren't going anywhere, Powell's not going to raise rates at the Fed anytime soon because he doesn't want to spook the markets.
Well, great stuff, Eric. Really appreciate it. A lot for all of us to absorb. And as I said, I recorded this, and I'll be sending everybody a link to everybody so they can review it. All of Eric's contact information will be included in that as well. So if you want to reach out to him with any specific questions, please do so. I want to let you know, and kind of, it's interesting, but on May 20th will be our next webinar, and I have our guest presenter will be Mitchell Dannenberg. He's from Long-Term Care Insurance Marketplace, and so that's all he does is sell long-term care insurance. And so he's going to talk about how do you understand your policy, and what things will trigger your long-term care, and how does it work with senior housing. So if you're interested, or if you have a long-term care policy, or if you're in the market, you probably want to attend that. That's on May 20th, again at 10 o'clock. If you have any senior housing questions, as you know, please reach out to me. I also appreciate your referrals. So if you know of anybody, if you have a neighbor or a friend, or see somebody in the grocery store that might need senior housing, please think of me, and I'm happy to help them. So have a great day. Thank you so much, Eric. It's been great. And
Thank you, Bruce.
keep
Appreciate
safe,
it.
everyone.
Thank you.
Thank you.
Thank you, Bruce.